Good morning, everyone, and welcome to today's webinar, Saving Your Condo Deals with Non-Warrantable Condo Loans. Now, as the webinar goes on, I'm sure that questions are going to come up. Use the little questions feature and ask your questions as they occur to you, and I will ask the speakers so that we can make this as interactive as possible. We're also going to have a Q&A session at the end of the call, so if anything we don't get to during the thing, we will definitely get to your questions at the end. With that, I will turn it over to Jay Goldberg. Jay, would you please introduce today's speakers?
Yeah, I'd like to thank everybody for coming onto this webinar today. We've got a lot of valuable information for you. My name is Jay Goldberg. I'm the regional manager of the state of Florida. I handle sales and service in Florida, which is actually the birthplace of the condominium. Also, we have Jeremy Drew coming to us from the West Coast. He runs a good portion of our West Coast operations. Summer Toscano is a very highly intelligent and successful account executive in Florida and does a very large quantity of condo and condotel. She's very well versed in the market. And we also have today with us Steve Moloff, who is the director of underwriting. He can answer any of your level 2 underwriting questions directly while we're on this webinar.
Okay.
In today's agenda, we're going to generally define the non-QM market and the market opportunity for you all. The differences between Fannie and Freddie condos and how they're handling condos in today's market and all of the changes in today's market related to agency business. We're also going to speak deeply about the new Fannie and Freddie or agency condo questionnaire that is just currently rolling out. It's already rolled out on the Fannie side and it's going to roll out next week on the Freddie side. It's a 7-page document with a lot of supporting documents to go along with it. We're also going to look at what makes a condo project non-warrantable versus warrantable, both in the agency side and the non-QM side. There's a lot of cases where a property might be non-warrantable or unlendable on the agency side, but it would still be a warrantable condo on the non-QM side. We'll take a look at all of our condo program options. They're very vast and they cover all spectrums of the lending that Lenshore does. Also give you some examples on how to rescue your condos and get them to the table for you. We'll look at the condo market and the opportunity along with the loan programs. And we'll also be bringing to the table today a very unique 40-year interest-only product that helps expand your buyer's ability to buy and buy larger. And then we'll have a little snapshot of how you will be successful with Lenshore and how you will work with Lenshore.
Okay.
Lenshore was founded in 2015. We're headquartered in San Diego, California, but we do have regional offices throughout the United States with main centers of operation in San Diego and Atlanta, Georgia. The pluses of that is that there's different mentalities between West Coast and East Coast, and we can actually address the population in our areas a little bit more directly to their wants and needs. Lenshore is not a third-party pass-through. We do not go to investors for approval on loans. We securitize all of our loans eventually downstream, and we've been doing securitization since 2017. Our management team throughout the whole United States has an extreme vast knowledge of all the non-QM markets, including the condo and condotel markets. Most of our managers have been in the markets between 10 and 30 years, so you can get, and they're very approachable, and you can get correct answers relatively quickly at any time. We are currently lending in 47 states, so we are a national company, and we can handle all of your lending needs. At Lenshore, we focus on making quality loans for quality borrowers. We are a just missed agency lender. We don't do any agency paper. When the people fall out of agency for vast reasons, we are here for them. We've got a full menu of products. We do bank statement loans. We do asset depletion, asset qualifier, debt service loans, investor cash flow. We also do foreign nationals, ITINs. We have a very unique fix and flip product, and an extremely unique bridge product that any of our Lenshore reps can help you out with. Our general loans range in our securitizations in FICO scores with 700 plus and on lower LTVs. We do go up to 90% LTV, and we are currently in the process of getting ready to roll out a 80-15 purchase money transaction product that's downstream. So we do go up to the higher LTVs, and we're getting into the higher CLTV arena. But currently we do go to 90. But our current borrowers are generally of a higher category, 700 plus, and they do usually have money down or equity in their properties. We do not do any Fannie or Freddie. We don't have any agency departments or ability to do any agency. We are a dedicated non-QM lender. So we do not do FHA. We don't do VA, HARP. We don't do foreclosure bailouts. We are not a subprime lender from the past. And currently, we don't do any second mortgage or home equity loans, but some second mortgage products are going to be hitting our menu relatively shortly.
Thank you. Jeremy, why don't you take us through a little bit about what non-QM is?
Sure, happy to. So let's first start with what non-QM is not. Many equate non-QM to be subprime. That certainly is not the case. The majority of our loans are just missed conforming or jumbo A paper borrowers. I think our average FICO is well above 700. Call it 707, 720, somewhere in that range is the average. Average LTVs are sub 70%. The majority of our doc types are bank statements. So that kind of gives you a little bit of an idea of the types of loans we're doing, but we're certainly not that subprime lender. Doesn't mean we won't do some tougher loans, but the majority of our loans are just those barely missed A paper conforming type of borrowers. So because of that, we've come up with a pretty good product menu and program menu that we can offer that helps service those just missed borrowers, many of which are self-employed. They've written too much off on their tax returns. Therefore, we pivot and have our bank statement program available, 12 and 24 months. A great non-QM program that uses all the income that's from those business bank statements and otherwise services a very, very good credit-worthy borrower on great properties and great LTVs with great assets. Other things that would kind of qualify us as non-QM would be some of the unique types of programs we do for property investors. We certainly will do the warrantable and full doc and property investor, but probably by and large, we're doing more of the non-warrantable condotel type of property investor that in many cases is either using our bank statement program, could be using our investor cash flow program where we're not even using income, we're qualifying the loan with market rents instead, could be using assets to turn that into an income figure either over a 5 or a 10-year period. So again, those are some of the things we're doing to qualify us as a non-QM lender on the investor side. We have other programs that really fit a great niche market. Foreign nationals is right now becoming a really hot program for us, especially in a lot of these resort towns and these resort areas. I personally cover part of the West, as Jay mentioned. We see a lot of foreign nationals in Las Vegas buying investment properties and second homes in Park City, Utah. So a great program that way. I already mentioned again that most of the condos that we are doing are probably non-warrantable and they're condotels, and that's become a real stronghold for us with the programs that we offer. And so, that hopefully gives everybody an idea of what non-QM is, especially with the Lenshore brand.
And to add on to that, and give you an example of some of the differences and the aggressive nature of Lenshore, net rental losses, alimony, and child support, we'll deduct that from income versus adding that to your debt. So you have a one-to-one trade-off. So your reduction in income versus added to debt, which at a 50% ratio would take $2 to cover every one. So we're very flexible in the way that we calculate income in order to be able to approve your borrower, not find a reason not to do your borrower.
Okay. Jeremy, why don't you take us through a little bit about what's happening in the non-QM market?
Yeah, sure. So I remember even 3 to 4 years ago where we were seeing forecasts from all the prognosticators about the growth in non-QM. Non-QM is going to become as much as 2 to 5% of the overall market, and certainly those things held true. We saw that growth even 3 to 4 years ago. We saw some real spikes in growth in 2020. Funny enough, as we thought that non-QM was just shooting through the stratosphere until COVID hit, and we all kind of took a little bit of a step back for a few months and, you know, looked at 2020 for what it was. But shortly after, you know, things started to ease up a little bit, you know, in the summer to fall timeframe of 2020, we started to see, you know, the non-QM segment really start to rise again. 2021, for anyone that's, you know, paying attention to non-QM, became a huge banner year for non-QM as an industry. As you can see, there were several forecasts and prognosticators, you know, looking at $18 billion of securitizations in the non-QM space. We, you know, shot past that pretty easily with 21 billion. And we're expecting that 2022 is going to be no different, especially when you consider, you know, the tightening of different types of programs and transaction types and property types from the GSEs. That's just steering more and more of the brokers and loan officers and borrowers needing a non-QM program and product. So we're actually really excited about the prospects for non-QM, and even in spite of a rising rate environment. So looks to be that 2022 is going to be another great year for us.
Fantastic. Just to answer a couple of the questions from our attendees. Good morning, Claude. And yes, this is being recorded. And yes, after the webinar ends, look for an email from me, Rose Waldy, that's going to have a link to the PowerPoint slides and a copy of the webinar recording. So feel free to go ahead and share that with your colleagues. And Kathy, you have a very specific loan scenario, and I want to make sure that you get as complete answer as possible. So if you could reach out to me offline, or I'll have a account executive reach out to you to work on that scenario. And we lend in 47 states, so most of the states. And the map with the couple of states that we don't lend in currently, which I can't think of off the top of my head, you'll be able to see that. Okay. And, sorry. Conforming condo loans today. Jay, why don't you take us through what's happening today?
So like I said, alluded to a little bit earlier, on December 17th, the GSEs rolled out, or Fannie rolled out their new condo questionnaire, and Freddie is rolling it out right now. So what has happened is they've really almost virtually disapproved any existing approved condominiums and are going from ground up for reapproval. This has really put a wrench into a lot of broker business and delays with it. The new questionnaire is, like I said, 7 pages long and has a lot of complex documentation that needs to go, you know, with it. So it's getting very, very difficult to get a straight answer on a condo or a condo sale, which agency doesn't do any Condotel, but they classify some normal condos that just allow short-term rental as Condotels, which we definitely do not look at a condo that allows short-term rental as a Condotel. There's specific things that make a condo different from a Condotel. If the questionnaire isn't filled out completely, or all of the answers aren't addressed, it's an immediate denial. Summer has run into this already in the last few days, where loans have been getting ready to close and the agencies have pulled out their fundings. And maybe Summer can speak to that for a second.
Yes, sure, absolutely. So I look at this slide and I see the word torpedoed. I had 2 brokers call me frantic in the 11th hour, 2 days before closing. Fannie denied the loan based on the condo review that they allowed short-term rentals and they deemed it Condotel. As Jay said, we don't look at that as a Condotel. We'll get into that later, but we've taken loans and we've closed them in record times on the Fannie and Freddie turn downs. So we definitely are willing and able and ready to look at your deals when they come over. Also, speaking to the questionnaire, I've often been asked several times over the last couple of years, especially now, will you take another lender's questionnaire? Lenshore does have its own questionnaire, and on this new one, we will not take it. We do not want it. There's too many pages. There's too much information. We have our 2-page questionnaire, and that is the information that we want to know. And at that moment, that's all we want to know. So the Fannie questionnaire is not of use right now.
Okay. So issues resulting from the new condo questionnaire. Jay, will you take us through some of these?
In Florida, most of the condominiums are self-managed by residents of the condominium. And they're doing this on a voluntary basis or maybe for a small stipend, but it's not their real main source of income. But when a condo questionnaire is sent over to the association, sometimes they're difficult to get back and they don't necessarily want to fill them out. And I say this with our very short two-page condo questionnaire. When they see the new condo questionnaire with all 7 pages and then the multiple supporting documents that are needed, they're very against even filling it out. And once the condo questionnaire is filled out and delivered to the agencies, it's on their timeline whether they're going to approve or not approve that. So it's making it very difficult to meet your actual closing dates. Purchase closing dates are very near and dear to us at Lenshore. We do keep track of when the projected closing date is. And even on the fallout deals, we try to use the best of our ability to meet those dates. So it's definitely having a direct effect on closings. And I think all of you probably have seen that some sellers, if you can't meet that first extension, they might pull out of that deal because their property is worth more today and they think that they can resell that property in a day or two and capture some higher revenue on the sale of that property. And so this condo questionnaire is having a direct link into your borrower's ability to actually buy the property. There's also increased reserve requirements. Like I said, the supporting documents is enormous. And a lot of this goes towards current assessments and future assessments and property inspections. A lot of this is coming from the collapse of the Surfside condo in South Florida, resulting in over 100 deaths. The condominium knew that the building was sick and they kept kicking the can down the road until the property actually collapsed. A lot of the condominiums started being built generally in the 60s and 70s and has continued forward. So there are a lot of older type condominiums that may or may not have been addressed properly, and the agencies want to make sure that they've accelerated the ability to look deeper into the walls of these condos. Not that Lenshore wants to lend on buildings that are falling down, but you can generally tell the difference between a maintained condominium and a dilapidated condominium, which you don't see that often. But the agencies are definitely going to drill very, very deep into it in current assessments and future assessments. One of the main problems is future assessment documentation is unavailable because they're planned projects, not bidded or paid for projects. So right there is a complete nonstop if that box is checked for a future assessment.
Jay, I've got a couple of questions related to short-term rentals. What's Lenshore's policy on short-term rentals, minimum night policy? What are other issues in addition to Airbnb rental to look out for?
We are extremely flexible. Like I said, I am from Florida. The short-term rental market is enormous in all of the beach areas, which the whole state is covered by beach area. And then right in the middle of it, we do have Orlando, with Disney and all the other parks around. So there's whole developments and whole condos of short-term rentals. As long as your borrower has the ability to occupy the property, we don't care about short-term rentals. We do have, and we'll get into it in a few minutes, about investor concentrations versus warrantable, non-warrantable, and Condotel. But we're near and dear to the short-term market. We don't have any requirements on minimum nights or anything like that. So it's just wide open lending. And in some cases, we'll even use Airbnb or any of the documentation on these short-term rentals for qualifying purposes when a 1007 might not be working, but a property is cash flowing at a much higher rate. We're extremely flexible. We're very in touch with that market, and there is no real overlays related to any kind of short-term rental. The only time that you'll have a problem with short-term rental is full restriction, which I only generally see in the Orlando area in some markets, where you do not have the ability to occupy the property at all. And that would be a problem, but that does not come up very often.
Thank you, Jay. And Robert and Deborah, I see your questions, and they're going to be addressed in the next couple of slides, so please bear with me. Summer, why don't you talk to us a little bit about the process for rescuing your condo deal?
Yes, absolutely. So what do you do if you have a condo turned down on your Fannie Mae side? Contact your Lenshore account exec right away. If you do not know who your account executive is, you can contact Rose and she will be sure to direct you to the proper AE. What we'd like you to do is submit some preliminary documents to us, your 1003, your credit, income, if we're using income for that loan, assets, and any of the documents below. If you have an existing questionnaire, we will take a look at it. If you have the appraisal, we will gladly take that as well. One thing about Lenshore is we do take transferred appraisals, not in our name. There is no transfer letter needed. It is something that is internally done on our side. Once you send us the documents, we review them, we discuss them, any exceptions on this scenario. Another thing, a great thing about Lenshore is if you do have an exception on a loan, we will isolate that exception. We will look for compensating factors to outweigh the exception. Present the file to senior management. Once approved, management signs off on that and your loan is safe regarding that exception. It is good to go. It has been isolated on the upfront side. Our process usually takes about 48 hours, depending upon the complexity of the loan, sometimes within 24, but typically 48.
Awesome.
The Lenshore condo questionnaire, it can be found by either contacting one of our account executives or going to lenshore.com under broker resources. We do not want the Fannie and Freddie version of their condo questionnaire. There's way too much information on there. But if you do look at our condo questionnaire and have an existing questionnaire from another lender that answers relatively all of the questions on ours, we will use that. We realize there is a fee in getting a new condo questionnaire. So we will look at that and see if it answers what we need answered and deem if we need one of our questionnaires. In most cases, the competitor or other lender's questionnaire will suffice and meet the needs that we have, so you don't have to get that second questionnaire done.
Awesome. And Jeremy, why don't you take us through what makes a condo non-warrantable?
Yeah, sure. So this is a pretty exhaustive list here, but this is actually not everything. But just to start out with, litigation, of course, on Fannie and Freddie, that's going to be a non-starter. It's going to be non-lendable. So not just a non-warrantable condo, they just won't lend if there's any litigation. We'll look at any litigation and consider the litigation. And in most cases, we're probably doing the loan anyway with some sort of litigation. We had an example in Park City, Utah, where there was litigation. Looked to see what the lawsuit was about. Found out that a kid was skating around in the ice rink and split his head open, and that was the litigation. We looked at the HOA reserves, looked at the overall aspect of the lawsuit, and decided that we're still good to go to lend on it. So we're looking at all the litigation, getting copies of the lawsuits, but in most cases we're still lending on that stuff. But litigation on an agency loan, that's definitely a non-starter. Occupancy, when we look at occupancy, again, if there is greater than 50% investor concentration in the property, it's done for, again, the agency loan. For us, we actually will go much higher than that. If it's a true condotel, we'll actually allow up to 100% investor concentration in the condotel. But even if it's a non-warrantable condo, we could still actually go up to as high as 90% at a reduced LTV and still get it done, even with those types of levels of concentration. A single entity could be an ownership of it could be an LLC that has ownership, or even an individual, but any entity that owns greater than 10% of the units. Again, that's another thing that makes the conforming and the warrantable condo non-warrantable now. That's something, again, that we'll continue to do and look to fund on that loan as a non-warrantable condo, even if it's above that. Reserves, that can certainly be a non-starter for Fannie and Freddie. Again, something that we'll review and look at when we start to review our own HOA questionnaire. But again, most times, in most cases, we're still doing that loan. Commercial use over 15%. In Utah, we actually, in Park City especially, we actually do a lot of condotels where the commercial usage is at least 15% or more. The entire first floor of many of these complexes is nothing but retail space. Again, we're still doing many of those. Again, that's on our condo questionnaire. We'll take a look at how much of the overall square footage is being used for commercial space. And again, we're still doing those in most of those cases. The project's not 100% complete. Jay mentioned there's aging condotel properties, built from the 60s and 70s. we're actually seeing very, very new projects, brand new projects out here in the West. We're currently actually working on and lending in and closing loans in the Pendry up in Park City. There's other new properties we're closing on as well that are not 100% complete. But again, it's a non-starter for the agencies. It's something, again, that we'll consider perhaps at even lower LTVs to do in brand new complexes. Unit owners not in the control of the HOA, that could speak to a number of things. Typically, it is for newer projects where the developer is still in control. The HOA does not have it yet. Again, reduced LTVs in many cases. We're still doing those. Something that Jay and Summer will see down in Florida much more is the rec leases. So properties with third-party managing amenities. That's something we'll continue to do. Also, we don't see that as much in the West, but down in Florida, I know they're seeing quite a bit of that quite often. The last couple here, land leases, and also things that we kind of touched on before, the short-term rentals, nightly, weekly. Fannie Freddie, they may say it's a condotel if it's being advertised for short-term rentals. That doesn't necessarily mean we'll call it a condotel. If there's actually options to opt out of the rental pool, somebody's actually going to use it as at least a second home. It's going to be owner occupied. Just because it's being advertised nightly and weekly rentals doesn't necessarily mean that we have to call it a condotel. But long story short is that we can actually continue to do those as well, either way.
Okay. Rick wants to know if you can give an example or two of a condo complex that Lenshore won't lend on because it's too risky.
Yeah, good question. So, in most cases, it really comes down to, if the litigation is related to more structural issues, right? Again, we'll review the lawsuit. We'll take a look at it. But that could be an example where, we may back out due to the structural issues and the nature of the lawsuit that way. There certainly have been structural issues come up in lawsuits before that we have reviewed and looked at as being minor to where we'll still continue to do it. But that could be an example where we actually may back out, right? So that could be an example there. Jay, Summer, I don't know if you guys have other examples that you guys have come across, but that's the one that kind of sticks out for me.
For the most part, it's a very hard question to answer because there's very few condos that we won't generally lend on. In the condotel arena, if the naming of the complex has the name hotel or motel in it, we will not lend on that property. We don't see that very often. But we're a very deep exception-based lender. So there's very rare times that we do so many condos and I really can't come up with a blanket statement of why we wouldn't lend on a particular development.
Yeah, one of the questions that's on the conforming HOA cert is any type of manufactured units as well, right? We actually had that as part of one of our bullets, and we actually took it out because we won't lend on any type of manufactured housing. So that could be another example that, depending on how that HOA cert's answered, that could be one other. But to Jay's point, we're lending on so many, it really comes down to more of the exceptions as opposed to the rules.
Marla and Deborah both have the same question, Jay, about you mentioned hotel and motel. What about the word resort? What about if it has resort in the title?
Resort, beach club, anything like that is fine. It's strictly hotel, motel are the only catchwords. Most of these properties know that. It's very rare that I do see a property come across with a sign out in front or an association named hotel and motel. But that would be one example of something that we would not be able to lend on.
I also do have an example of a non-warrantable that we could not lend on, and it's with reference to the reserves. We do have a lower reserve requirement than Fannie and Freddie. However, we do have a reserve requirement. I did have one that had 0 reserves and we could not get that one through. We will be flexible with that number, but 0 is pretty much a hard stop on the reserves.
In some cases, we have gone down to the no reserves or self-funded, and that will drill deeper into the quality of your borrower. But that would be a senior management exception, but I see those a lot. Reserves coming in lower, or in some cases, some condos do within their condo docs have agreements of minor assessments based on current spendings. And in some cases, not all cases, we will lend on them. Generally with Lenshore, it's very hard to have a blanket no. We cannot fund every loan, but we are more than willing to look at every loan with the direct idea of finding a way to make it happen, not find a way not to make it happen. And that's what's happening in the agencies, that you are really turned down until approved, and we're approving as much as we can to avoid the turn down.
Yeah,
Paul
and one final comment on the resort question as well. We actually are really drawn to those properties, and the reason I say that, first of all, we're lending in a lot of those properties that are advertising themselves as resorts. We're doing a lot of units. We're closing a lot of loans in Vegas, you know, that are being advertised as resorts. We're doing stuff in the MGM Grand. We're doing stuff in, you know, Palms Place. We're doing stuff in Trump Tower. In St. George, Utah, there's a lot of golf course communities that are being advertised the same way. The reason why we're drawn to those is not only because we have the program to support it, but the average buyer, the borrower that we're getting, is a very, very, you know, good borrower. We're talking 740 plus credit, full doc in many situations, assets, you know, enough in many cases they could actually pay cash for the property. They would just prefer not to use their own money. So we're drawing a very, very high profile credit worthy borrower in most of those situations. And that's why we really look towards doing those types of properties that are even being advertised as resorts.
And back to the hotel motel, there are some instances, especially on the higher dollar properties, that word is not a direct turn down. We're doing a lot of business in the Meridian Hotel, the residence of Ritz-Carlton, where a lot of these buildings are actually triple buildings, where you might have a hotel, a standard real hotel on the bottom. The 17th to the 27th floor is a Condotel, which is managed by the hotel for the owners of it. And on top of that, you have the residences. Each of those segments of those properties have their own associations and their own overlays. So you generally have a master association and then sub-associations. So when you see those known names, you've got Hyatt, you've got Marriott, the Meridian, Trump. So when you see a property like that and the word hotel in it, that is not a turn down. But when you see your more beachy type, single story, lower end condo that just looks like a hotel or a motel and it's called a motel, those are the ones that we can't lend on. So I just wanted to show the differential between those two. So it's not just that word, it's also the essence of the property.
Paul wants to know, when we do find issues that we mentioned and it comes up, can we lower our LTV and then approve, or what do we do at that point?
That's definitely case by case. We are aggressive. We're looking for a way to lend on it. We're looking at the stability of the overall condominium, and really the borrower that we are lending to has the most merit.
Yeah,
and just to add on to that, you're right. I mentioned that we're doing and closing units in, you know, the MGM and you know, places like that. Those are high-rise condotels. Our guidelines actually don't specifically call out that we will do high-rise condotels. What we will do, to that very point in that question, is that we will review the property with senior management, and upon senior management approval, we'll reduce the LTV and still do the loan. And that could actually happen with not just high-rise hotels or condotels. That could happen with a whole number of different types of properties that may have some concern or question on, but nonetheless, we'll still do it at maybe some lower LTVs and reducing our risk that way. The Pendry in Park City that I mentioned, that's a brand new complex that we really don't want to be the first ones in any complex. But when we look at the right type of situation, like a Pendry, and the types of properties they are, in this case, there was 153 units that were pre-sold before we started even closing on any loans. You know, nonetheless, we don't want to be the first ones in. We still decided to be one of the first ones in at a reduced LTV. So there are going to be those one-offs that we can review, take up to senior management, still get it done just by reducing those LTVs and reducing our risk that way.
If we add on to that, we are an early entry lender in Florida. There's a lot of cash transactions. So when a condo, a new build condominium closes or COs, generally they will close the cash transactions to establish the comps, and we will come in right behind in most cases after the cash transactions close to establish the comps. So we are an early entry. We're not in some cases, we might not be the first closing on a building, but we don't have a requirement of 25% of the building must be sold and closed or anything like that. So we will look at all of those newer builds.
Okay. Mignon wants to know if we have a minimum and maximum loan amount, and Rick wants to know what our maximum LTV is.
That's kind of a floating target. Our maximum loan right now is $3 million. But even with that said, 2 months ago, we closed a $5.4 million loan. There's very tight circumstances on that loan. So, but $3 million is generally the rule on the top end. The smaller the loan, the smaller the revenue. So of course, we do like to have increased loan sizes for both you and us. We will dip into some of the lower ranges. Our minimum loan right now generally is $150,000. I did close a loan last month at $86,000 as a favor to a broker and as a package deal with another loan. Like I said, we are a flexible lender. So even our guidelines say minimum loan of $150,000. We will go lower on a case-by-case basis, definitely based on the relationship with the broker community.
Okay, thank you. And Summer, why don't you take us through some of our program options?
Absolutely. So your non-warrantable condo, that's going to be your property type. That property is available on many different programs as far as your qualification. We have 12 and 24 months bank statements. They can be personal or business. Our full doc program is a 1 year or a 2 year program, as well as we have a 1099 program, again, 1 and 2 years. It's a very aggressive program for your 1099 borrower, and it is priced as a full doc. It's not an alt doc. We have an asset depletion and asset qualifier program that is great for your borrowers that are possibly income poor but asset rich. We will use their assets, percentages of their assets, and qualify them using that for an income. Our investor cash flow is a wonderful, very popular program, the DSCR, that's your debt service coverage ratio. That program requires the rent on the subject property to cover the proposed all-in mortgage payment on the subject property, no income associated with that. Our foreign national program, you know, definitely in Florida, I'm sure other parts of the country, but what we're experiencing is very, very popular. We offer the non-warrantable condo on the foreign nationals. We also, very unique to Lenshore, have merged income doc types. We've had many times where a full doc borrower, W-2 pay stub, their DTI is just there or a little bit under. We will combine that with asset depletion. If they have some good assets in the bank, we can use some of that to get that DTI to work. Just adds to the flexibility of Lenshore and the common sense lending the way that we think. Our loan sizes, Jay spoke to that a second ago. We do jumbo loans. We go up to $3 million on that. It is scaled based on LTV, but we do love the jumbos.
Okay, and I got a couple of questions here. What about limited reviews based on LTV?
No, we do not. We still do require the condo questionnaire to be completed.
Okay, and Glenn wants to know, can you still get a short form condo questionnaire, or is that no longer available with the new Fannie Mae questionnaire?
From what I'm understanding, that they are no longer using the short form since the rollout of the new form, and they're reevaluating existing buildings. So that's not guaranteed information. That's just information that I've been told, but that's not, that there could be some flexibility in there. I'm not absolutely 100% sure.
That's also the part that I love about our condo program is our normal questionnaire is 2 pages. So we'll give you the short version. It's just going to be the Lenshore version.
Do you still offer I-10 borrower programs?
Yes, we do.
What about fix and flip?
We have fix and flip. We also have our bridge product. Our bridge product is very unique, where we can extract the equity out of a listed property with no debt ratio ramification and no payment due on a 12-month balloon. The 2 loans are combined, cross-collateralized. So when a property comes up on the market that Mrs. McGillicuddy's always wanted and never thought that it was going to be for sale, sees that for sale sign, hits the front, they can immediately put an offer in, and we'll extract the equity out of their existing property immediately and move it over to the new property. The interest rate on that loan, like I said, was an interest only with no payment expected or due or collectible. And the cost of funds on that is a 0.556 per month. So in the moving market that we're in right now, they can pull that equity, move it over to the new, sell that existing house, and have very low overhead cost and no debt ratio ramifications.
Bob wants to know, currently the condo complex is having new deck, sliding, flooring being done on the building, so improvements are in process. What about those?
That would be handled as an exception based on what's going on, the current photographs of it, the contractor type, and the funding of it. If a reputable contractor is doing it, if there was assessment in line that we know that it's already there and already approved, it's definitely something that we would look at. I mean, we do look at the viability of the building. Upgrades are upgrades, and you'll see, especially in the flow that we're going on right now, especially in some of the old buildings, that you might have a full window replacement going on in the building. As long as your unit has been already completed and the financial stability is there, we'll definitely look at that loan.
Okay. On a bridge loan, can you be bridging to another state?
On the bridge loan, that is generally for owner occupied, a higher quality borrower. And you definitely, I think you can bridge to a different state as long as they can cross collateralize on the titles. We don't see a lot of that, but I don't think that would be a problem as long as the titles can come in line.
Thank you. Several people are asking if they're going to get a recording of this. Yes, I'll send you a recording after it. Look for an email from me. And Claude, we're going to be talking about interest only in just a couple of slides, so please stand by. With that, let's talk a little bit about Condotels. Summer, do you want to get us started?
Absolutely. So what is a condotel, also known as a condo hotel? A condotel is a condominium project that operates like a hotel. It will have a registration or a check-in desk. It will offer cleaning services, have a master phone service, hotel-like amenities. One indication that something is a condotel is the sign outside. We've spoken to before, has the word resort, beach club, Sunnyside Vacation Rentals, words like that. When we see that, that puts it in the condotel category. A condotel also can offer a rental pool to the unit owner, where the unit owner has the opportunity to put that unit in a rental program to help generate some revenue and offset some costs. That is perfect. That is a condotel. That is no problem. You want to keep an eye on that because there are certain situations where the rental pool is a mandatory rental pool and the unit owner has to put them in that pool. We typically will not lend on those type of properties where it is mandatory. However, that is a gray area. So when that does come up, we will review that on a case by case. A condotel can also have up to 100% investor concentration. It doesn't have to have 100%, but it can have. In situations like that, 100% investor concentration, no problem, condotel, perfect. There are times where the 100% investor concentration means only investors are allowed to own this condotel, and the unit owner is not allowed to visit or occupy that property. He is restricted to that. Again, we will typically not lend where the owner is restricted on his use of the property, but gray area, and there are exceptions to be made to that. One thing with the condotel program, it maxes out at 75 LTV, whereas the non-warrantable program can go up to 80. So it is very important for us to make sure that we identify your property properly. Going back to the fallouts on the Fannie Mae side, when the property is identified as a short-term rental, right away it's a condotel according to Fannie. When the broker calls me, you know, I tried to get some more information because although they deem it condotel, we necessarily will not deem it condotel just because of that short-term rental. We'll put it in the non-warrantable bucket, which will get you a little bit higher LTV. Also, your condotel, it can be a second home or it can be an investment property. Sometimes people think condotel, hotel, investment only. That is not the case with us. We can do it as a second home. And on your slide, your hotspots for Condotel are definitely Florida, definitely places that Jeremy's working with, Park City, Las Vegas, more of your vacation resort areas. However, we are seeing them pop up in urban areas like Chicago, New York, Boston's having a couple. So, you know, as the market grows, they might be popping up a lot more often.
You do see it from time to time, but we'll also do primary residence within a condotel. A lot of people don't want to live 365 days a year in a condotel, but there is the availability to do that, and that would be a trib-based loan.
Okay, Jeremy, anything to add?
Yeah, I think Summer really did a good job covering it all. The only thing that I would add to it is that I think the real question is, you know, who is using what definition of what they call a condotel, right? If it's the agencies calling it a condotel, they're going to call everything from the obvious, right, features of a condotel, check-in desk, you know, amenities that are similar to a hotel. Those are the obvious ones. We'll call those a condotel as well, but Fannie Freddie is also calling, you know, that normal looking condo, townhouse looking complex a condotel when they are advertising resort, as someone mentioned, advertising short-term rentals. Again, that doesn't necessarily mean that we're going to call it a condotel. And so when those borrowers are looking to possibly occupy the property, at least as a second home, they have the ability to opt out of the rental pool. It does not have all the usual features of a hotel, a check-in desk and things of that nature. In most cases, we're not calling that a condotel. So I think it's really important that when you look at, you know, the definition of what a condotel is, keep in mind that we have a little bit different definition than what the agencies do.
Kim wants to know if we have a questionnaire type thing in the sense that we can ask the realtor or the buyer to see if it's a condotel.
Generally, what we look at and spend a lot of time on Zillow or Realtor.com, and your listing in most cases will kind of give you the tip off of whether it is or is not a condotel. Secondly to that, the condo questionnaire, the 2-page questionnaire will definitely let you know if it is a condotel. They're not very hard to determine, and so it's very easy. It's kind of cut and dry with us.
Okay.
Yeah, and in most cases, right, when we have a borrower that clearly, you know, states on the 1003 they want to occupy the property as a second home, to Jay's point, we're looking at Zillow, we're looking at Redfin, Realtor, we're looking at all the public websites, and the first thing that we're looking at is, does the HOA allow them to opt out of the rental pool, right? That's the first thing, right? Beyond that, right, the question just ultimately becomes, you know, does the story make sense? And ultimately, if the project and the HOA allows it to, you know, be considered an owner-occupied property, they can opt out of the rental pool. They're designating the transaction as a second home. Again, in many cases, we are now calling that just a non-warrantable condo as opposed to a condotel.
Your main difference is it self-managed or is it managed by somebody else? Short-term rentals are generally self-managed, not condotel. If there's a registration desk where people are picking up keys and calling down for services and things like that, it is a condotel. So it's pretty cut and dry.
So Karen wants to know, so what about an on-site rental desk?
An on-site rental desk generally is a trigger to making it a condotel.
Okay, great. And Jay, if you could take us through some of the program guidelines.
So on purchases, we'll go up to 75% on a condotel, 70% on a rate and term refinance, 65% on a cash out minimum credit score of 740, which is only related to the cash out. We'll go up to 70% on a DSCR, investor cash flow. Our minimum FICO score is 680 on our AA program. Investment properties and second homes only, generally in a condotel. But I did say a few minutes ago, there are certain cases that if there is no mandatory pooling or anything like that, that we have the ability to, in some cases, to do them as owner occupied, but does not come up very often. We will go up to 100% investor concentration on them. A couple key features are minimum square feet of 600. We will go lower than 600. Our standard step down is to 500 with simple approval. And we've gone down to the smallest I've done so far is 454 square feet. The underlying biggest difference between a hotel room and a condotel room is a livable kitchen. What makes a kitchen livable is the stove. If it only has a cooktop, generally it will not be that will be a hotel room with a kitchenette, not a full kitchen, and we will need that full kitchen in there. Size of the refrigerator doesn't necessarily come into play, but the oven is very, very important, and that would be a strong overlay right there, and there generally is no way around that.
Okay. Misty wants to know, no PMI?
No PMI. We are not an agency lender, all the way up to 90%. We don't have the ability, nor do we charge it.
Does it cost to submit a scenario? Ashley wants to know.
Absolutely not.
Okay, great. With that, Jeremy, if you could talk to us a little bit about our 1040 fixed rate interest only.
Yeah, happy to. This is actually, one of our flagship programs. Anybody that has dealt with any non-QM lenders knows that this is not a common program, even if the other, if our competitors even offer interest only. So the fact that it's a 40-year fixed loan alone is pretty attractive. But we call it the 10/40 because, again, it's fixed for 40 years. But the first 10 years is the interest only portion, and then followed by the remaining 30 years being fully amortized. So again, the 10/40, just a phenomenal product that a lot of investors are flocking to. We do use this on just about every single program, but it's especially popular with our investors, our DSCR program in particular, where we're not even using income to qualify. We're actually using the market rents that are coming back from the 1007. And so when you look at our investor cash flow program, it could be any investment type of property. It could be bank statements, full doc, asset depletion, you name it. Anytime we're looking at an investor type of transaction, we can actually use the starting payment, the starting IO payment to qualify that borrower and get those ratios to work. So when you look at that, combined with some of the other features that are unique to Lenshore, we can actually, a little bit ways down here, we can actually buy the rate down in conjunction with the 40-year fixed IO. And so between the lower rate from buy down with the IO, we're really now starting to cash flow the property, getting ratios to work on any of these programs. But one of maybe the most interesting features that is, again, fairly unique to us is the discount points that we use to buy that rate down can actually be financed into the loan. So our rule of thumb is that we can typically finance up to 2 additional LTV points into any loan, typically 85% or under. So if we have a 70 LTV loan, we can actually finance a 72, which could include not only buy down and discount points, but also LO comp, broker comp, and actually, keep that money back in pocket, for those borrowers and free up that cash to close for them in other ways. So, just some really amazing features that are unique to Lenshore, the 40-year fixed IO, the ability to finance points and comp into the loan. All doc types are available for this. The 2 sets of criteria that in our guidelines that everyone should be aware of, the borrower does need to have at least a 680 plus FICO. LTV needs to be 80% or below. But if they meet those parameters, we can do them on any doc type. We can go all the way up to $3 million. And so, a lot to work with, especially on investment properties using the starting payment.
Okay, thank you. Jeremy, do you want to talk to this information?
Sure. So hopefully a lot of the things we've already been speaking about, some of these programs, including the last slide, that are unique to us, those are reason enough, hopefully, for folks to recognize the importance of working with Lenshore, right? Everything from, our 40-year fixed IO to our ability to do condotels. Those are all reason enough just from a programmatic standpoint. But, the other things that I think should be highlighted is our flexibility to, structure and, fund loans, based on a lot of different types of exceptions that may need to be made. We certainly have our guidelines like every other lender, but they're not our laws of lending. We don't look at them that way. We look at them as truly that, they're guidelines, right? And so if there's exceptions to be made to those guidelines, we're oftentimes looking at what those exceptions are, what are the compensating factors, built around, the borrower, the collateral, the overall credit profile, and can we make these exceptions? Does it make sense? So when we talk about being a make sense lender, we truly put our money where our mouth is, and we're structuring loans, making several exceptions where they make sense. So the flexibility we have to make exceptions, the programs we have, And then, Summer touched on it, earlier here in the presentation, but the last piece that I would just underscore that really is a differentiator with us is what our pre-qual and our pre-approval process looks like up front. So to get you guys a really solid decision within 48 hours, all we ask for is just a few documents up front, typically the 1003, the credit, the income docs, if we're using income. Again, with our DSCR program, we don't use any income. We're actually looking at market rents instead. And then we'll grab assets. We'll take a look at the property online in many cases if we don't have an appraisal already from a fallout loan. But we'll grab all those things within 48 hours. We're having an underwriter do a full underwrite on all those items. We'll have ratios for you. We'll know exactly what we're looking at and decisioning on, at least from eyeballing the property at the very least. We'll have obviously credit involved in that underwrite and in that decision process. So within 48 hours, we're giving you a real decision. We're putting our signature to it with real rate and terms and even conditions. So within 2 days' time, you can get a real decision back to your borrowers. They can go under contract with confidence, knowing they've got a real loan decision with them. We'll let you have that information within 48 hours. So that, again, gives you guys confidence that you're moving forward with a real loan as opposed to something that could fall out 2 to 3 weeks later downstream.
And come over the top on that one of the big differences between Lenshore and a lot of our competition is we pride ourselves on the knowledge that our AEs bring to the road. Our AEs are not order takers. They're not paper pushers. They're actually true lending professionals that are highly trained. They're also trained to engage deeply with the broker community. An example of this, I got a phone call about 1.5 years ago from a broker up in the panhandle of Florida, and started a conversation with, I've never done a non-QM loan before, and I really want to learn about this, but I have no clue of what I'm doing. So we started walking him through the process and what non-QM was, and he got his first loan, and we helped him with each of those documents. And currently that organization has expanded in the panhandle astronomically, where Summer's closing over 10 loans with them a month, and the other realtors and brokers are actually going to public records currently to find out who was closing loans in these buildings that they could never ever get loans in. And in the last 60 days, we've had 3 or 4, blanket just calls coming in telling us that they found us in public records as a lender in a certain building or a certain area. But we will take the time, especially in the conversion to non-QM or the conversion into the condo and condotel market, that we have time, we have energy, and we have the expertise to actually go one-on-one with you whenever you need, at any level that you need, from the first time you've ever done one of these loans or you're a seasoned professional, and we'll walk you right through that process. I'm holding your hand all the way.
Awesome. So with that, any questions that you have, please go ahead and submit them, and we will get through as many as we can. Do divorces have to be final?
In the state of Florida, you're either married or you are divorced. There is nothing in between. A lot of these condotels are non-TRID loans, or they're business type loans. So the divorce doesn't necessarily come into play, where there is no signing of the spouse. But on a TRID-based loan, the divorce would have to be complete, or both borrowers would have to sign.
Okay. Nelson wants to know, what about the same owner having 50% or more ownership of the other units?
That would, in most cases, not be possible. Generally, we allow up to one entity owning 10% of a building. We will make exceptions above that. There's different types of buildings. Since we are not an in-the-box lender, there's definitely the difference between a condominium that has 15 units and one that has 450 units. So again, that would be, considered on a case by case. But when you get up into those higher unit totals and higher penetration of 50% on a 200 unit building, no, we would not do that. That would be more of a residential rental. But those are questions that we handle on each individual loan scenario, and we'll get you an answer as quickly as we can, which usually is almost immediate.
Anthony wants to know, are we able to review a matrix that summarizes product offerings and basics? Also, are rates available daily, and where can we preview those?
Any of our account executives have the freedom to give you our complete matrix and rate packages anytime that you need them. If you reach out, if you do have an account executive currently, you can reach directly out to them. We don't hide our rate sheets or our matrices like some other people do. If you don't have an account executive currently, if you reach out to Rose, she will get you in touch with the regional manager of the area that you're in for AE assignment to get all that information to you.
Drew wants to know, assume that you are not subject to the 400 basis points fee that will begin on Fannie Freddie loans on second home starting April 1st.
Not at all.
That's loan level pricing. I think he's speaking to that they announced, right? And so that's completely subject to the GSEs and what they're dealing with. What we do, we're pricing our stuff based on our own investors and things that are completely detached from the GSEs.
Joanne wants to know, where can we find marketing material and social media post items for this stuff? Look for the email, the thank you email from me that you're going to get in about an hour. I'm going to include a link for you to our private label resource kit that includes email templates, social media posts, flyers that you can customize with your logo, all of that stuff, not only on these programs, but across the programs that we offer. So I will take care of that for you. I may have missed this in the slides, but
sorry. Also related to the pricing question, if you go to lenshore.com, you'll see up in the toolbar on our website a tab that says Spark Pricing. You can go, that is an active, true to time pricing engine. But the one thing I want you to be aware of is that we are an exception-based lender. If you do not get a approval on there, you really want to reach out to your account executive or the management of that area to see if we can turn that loan or that turn down into a loan. The pricing engine is based on the in-the-box theory, where we do a lot of out-of-box lending.
Awesome. I may have missed this in the slides, but can I do bank statement loan on a W-2 borrower? That question is from Glenn.
No, you cannot. Bank statements are reserved for self-employed only. Now, in the event that they are a W-2 individual, but they do, let's say, gig work, or they do stuff on SD, we can divide that income, like Summer was alluding to earlier, on a multiple doc type or a hybrid loan. So in cases you would have your W-2s, they would be extracted from your bank statements. We would have a self-employed questionnaire kind of dictating what type of business they are in, the revenue, and we will pull that income from your bank statement. So it would be a dual doc type loan.
Okay, great. Mike wants to know, other than the additional 5% LTV, is there any difference between the non-warrantable and Condotel loans?
No, they typically go hand in hand. Obviously, the difference really is what really is the property that we're dealing with, right? And so when we start to determine, that really is a condotel versus a non-warrantable condo, that's obviously the reason for that 5% LTV reduction from that program max. But outside of that, pricing is very, very similar, right? The underwriting process, everything else, condo questionnaire that we have them fill out, all that stuff is the same. So it really just comes down to what LTV we're dealing with as a result of the determination we're making on that type of property.
John wants to know, are all products available in fixed and ARM?
Currently, we are doing all products on fixed rate. There is no rate adder for fixed rate. That's related to the 2 and 3 year swap, that the value of a 30-year fixed loan on the secondary market is valued at a higher level than an adjustable rate. With the current movements in the market, that could change at any time. But currently, we do everything as a 30-year fixed. If you did want an ARM, it would be priced the same.
Yeah, we haven't priced an ARM, honestly, for that reason for probably over a year.
Mike wants to know, what's the longest fixed rate term you offer?
30-year.
So that would be the 30-year straight fixed amortized, or the 40-year IO, which would be a 10-year interest only, with a 30-year fixed behind it. So that would be a 40-year term, but the first 10 years would be interest only.
And we
Kim
also
wants
do not offer less than a 30-year. I often get questions about a 15. We don't go under 30.
Okay. Kim wants to know, different property type than we are discussing, but on the 40-year IO, can you do DSCR or bank statement loan on a 4-unit?
Yes.
You can, and so it really just comes down to what LTV are we at, and does it fit within that program, and do we have a 680 plus FICO?
Awesome. Well, with that, I'd like to thank everybody for attending today's webinar. Again, keep an eye out in about an hour for an email from me with a recording, a copy of the slide deck, and with a link to the private label resources. Jeremy, any last words?
No, we just really appreciate everybody joining us today and hearing about what we have to offer on these investment programs, specifically condos, condotels, non-warrantables. This has been a super hot market for us, with all these programs. And again, as I mentioned earlier, we're getting such a really good high grade borrower, in these types of transactions that we aggressively want to do more and more of these. So we encourage you all to reach out to your local account executive. Let us know whatever we can do to help you market this. We want to be an extension to you, out to all the agents that you work with. But at the end of the day, we really want to be a partner with you guys to go and get more of this business.
Thank you, Jeremy. Summer?
Yes, I just really want to stress the importance that the relationships that we built with our customers are to us. Partnering with Lenshore, you really are in good hands. The support personnel that we work with, from the account executive all the way up to senior management, everyone really takes your loan to heart. We are in the business to close your loan, not to kill your loan. We're always looking for ways to restructure if we have to. Killing a loan, once a loan hits our pipeline and it doesn't close, it negatively affects everyone, and they do take it to heart. So you really are in good hands with us. And also, one thing we'll give you on the front side, we'll give you a quick no. If we can't get the deal done, it doesn't, no good for anyone to go down a rabbit hole and waste hours and days of maybe. If we can't do it, we're going to tell you no. Although we would love to close every single loan out there, we know we cannot close every single loan out there.
Awesome. And finally, Jay.
And just to touch on service for a second, our service platform is based on a team mentality and a partnership mentality. So you're not going into a round robin. Generally, for the most part, the underwriter that is working on your first loan is the same underwriter that's working on the 30th loan. Your processor is your processor, your AE is your AE, and the management behind that is the same manager. So you should see the same output on a regular basis. So you're not jumping, the same conditions come up, you're not looking at different thoughts or different processes. And the idea is that we will modify how we do business to accommodate you, and it's all about that relationship and that partnership. And we like to take that, and with a lot of our bigger clients, we're very deeply embedded in their organizations as well as they're deeply embedded in ours. It's all about a seamless approach, a smooth approach, resulting in the funding of the loan and a revenue generating event.
Awesome. Well, thank you to our speakers today, and thank you for everyone for attending. Have a great day.
Thank you.
Nailed it.